Today, Bitcoin prices sink after a U-turn from Elon Musk that one Wall Street analyst called a shocker. Plus, after nearly a week offline, the largest fuel pipeline in the United States has finally resumed operations. And finally, this week's higher-than-expected inflation readings are sparking fears that the post-pandemic economy is getting too hot, too fast. I'm Pippa Stevens, and this is CNBC After Hours. Stocks climbed today as the Dow and S&P each roared back more than 1% after ugly losses yesterday when the Dow suffered its worst day since January as inflation accelerated. Yesterday morning, the Bureau of Labor Statistics released data showing consumer prices jumped 4.2% in April, higher than economists had predicted. This morning, we got another indicator that inflation is heating up. Production prices rose 6.2% from 2020, the largest increase since the data started being tracked in 2010. This economic data reflects what we're all seeing in our everyday lives. Food prices are higher, home prices are rising, and lumber, well, those prices have hit the stratosphere. So how did we get here? Why is the stock market so spooked by inflation? And what do the people in charge of this, aka the Federal Reserve, have to say about these latest indications? The After Hours team asked around for some answers.
When the U.S. slammed on the economic brakes in March 2020, experts and policymakers were terrified of a prolonged recession. The Federal Reserve pumped trillions of dollars into the economy to keep it afloat.
What it's come to right now is so far well in excess of $5 trillion from Congress, another about $4 trillion worth of stimulus that's come from the Fed.
And despite massive financial devastation to many Americans during the pandemic, others found themselves with unexpected savings, and they spent them. Consumers stocked up on groceries, renters rushed to buy or build homes, and cars became the best way to travel while keeping social distancing in mind.
The past year has been the year of the biggest change in the retail industry and the landscape for the consumer. We call it supercharged change. A lot of the headwinds of the retail landscape that everyone had been talking about for years has now dissipated. If you think about it, people are saying everything's going to go online. People aren't going to go to stores. Well, that didn't happen. Stores only became more essential.
All this demand combined with ample economic stimulus has led to a new concern for economists: inflation.
When you go to the grocery store, when you go to the gas station, when you go to just kind of buy your big ticket items and those kind of things, just basically everyday life, we look for signs of price increases, and that is what we call inflation. What the most basic definition of it is too much money chasing too few goods.
The Consumer Price Index, which measures the costs of a variety of goods in the economy, rose 4.2% year over year in April. That's higher than experts were predicting and the biggest jump since 2008, the height of the Great Recession. Energy costs surged 25% year over year. Used car and truck prices climbed 21%. Lumber prices, 124%. Costs are rising everywhere.
Home prices are up about 12% compared with a year ago, and they're still accelerating pretty quickly at the fastest pace, in fact, in over 15 years. So what's that doing to the market is you're seeing a lot of bidding wars. You're seeing houses sell extremely quickly, in some cases 1 week or barely 2 weeks on the market.
Inflation is a risk for investors, too.
Stocks return about 8 or 9% a year. That's the historic average. If you factor in 2% inflation, that means the real return, the inflation-adjusted return of most stocks, is 6-7% a year. But if inflation changes, that can be a problem for the stock market.
Restaurant prices are rising as well as those business owners face a labor shortage.
I just did the pricing menu and I I took things up $2.
Percentage-wise, give me a sense. 5%?
Okay, 10%? So how about a $6 beer to $8?
But the Federal Reserve doesn't think any of this is a long-term concern.
They believe that we can expect to see inflation rise in the coming months. We might even get into territory that looks a little bit scary, but they believe that this is all just temporary.
And those on Wall Street don't see it deterring consumers either.
Broad-based people are going to go out and spend money. I think they've had the savings to spend money. I don't think they've been out. They've been on lockdowns for a long period of time. I think they want to show newness. I think they want to get out there and think of it as a way of socializing.
Okay, let's get to our Soundcheck. Here's a roundup of the day's biggest action and what the top newsmakers and business leaders had to say on CNBC's airwaves.
our companies are all growing, tech companies are all growing. They have a record high profitability and so on. It's just that the people's view on the long-term interest rate and just a cyclical thing. It's no fundamental change.
I think, COVID definitely accelerated things, probably pulled up e-commerce by a couple of years. And, things did run up, like you said, and now it's just selling off a bit. I think long-term, obviously, e-commerce has still got a long ways to go. It's still early innings here. And, feeling bullish still.
As we see the UK easing lockdowns, the US with the stimulus checks, we are noticing re-engagement. That is such a strong sign that people are ready to get back out there and to see each other in real life. And so again, we really feel that we benefit on both sides of this coin.
When you look at our policy framework, our laws, a lot of them were not written for the cyber era. It's one of the reasons the president's executive order is coming at a very important time and part of a bigger picture where we really need to make sure that we are harder targets for these kinds of cyber actions.
Bitcoin prices took a nosedive in the past 24 hours, falling below the $50,000 level for the first time since last month, and wiping as much as $365 billion of value off the total cryptocurrency market at one point. The drop came after Tesla CEO Elon Musk tweeted that the company would no longer accept the cryptocurrency as a form of payment for its electric cars. He cited concerns about the use of fossil fuels in Bitcoin mining. It's a pretty big U-turn for Musk and Tesla, which only announced in February that it would allow customers to pay with Bitcoin. One Wall Street analyst who covers Tesla called the move a, quote, shocker. We asked Kate Rooney to break this all down.
So Wednesday evening, Elon Musk, of course, Tesla's CEO, he has been a longtime crypto and Bitcoin bull, tweeted out that Tesla will stop accepting cryptocurrencies as payment for Tesla vehicles. Bitcoin fell 7% at the time. It's now below $50,000, which we haven't seen since mid-April. A lot of people were nervous about that announcement. Bitcoin's carbon footprint has been out there. It's sort of an open secret in terms of Bitcoin's impact on the environment. People were surprised that Elon Musk announced this now that he's already made a couple different moves in crypto. Another thing to point out, Elon Musk and Tesla have added Bitcoin to Tesla's balance sheet. So they hold it as sort of a form of cash. They actually sold some in the first quarter. He's not selling that. So Tesla is still a major holder of Bitcoin, meaning that they are incentivized to sort of make it greener, to make Bitcoin work. So a lot of people have warned about Bitcoin's sort of dirty ESG score, everyone from Bill Gates to Janet Yellen to Elon Musk more recently. But there are estimates out there from different Wall Street banks. One shows that Bitcoin emits more CO2 than entire countries. Greece is one example. So that's been a huge headline for people that, wow, this entire process often emits more CO2 than entire countries. On the other hand, people have argued that in a lot of cases, Bitcoin is actually using excess energy that wouldn't be used otherwise. There's also clean energy being used in a lot of cases. Canada and Iceland, they use wind-powered energy. In some instances, there is sort of a sense of betrayal in the Bitcoin community. People really saw Elon Musk as an advocate, and others have pointed out, hey, he's not completely abandoning this. He said in that statement that he was looking into other cryptocurrencies that use less energy. He essentially said that he's still a believer in Bitcoin. So this really isn't an about face. I think he is still committed to it. I think it just doesn't make sense in the context of selling electric vehicles when you think about the carbon footprint. One of the big things you realize covering cryptocurrencies, they're very volatile. They'll go up or down by 10% in a day. Bitcoin has been a little bit more stable recently, but historically, whether it's a tweet about fear of regulation, some sort of influencer or CEO tweeting about it has often moved the price. More recently, Elon Musk has been one of the biggest, better known influencers in the crypto market, and not necessarily with Bitcoin. We've seen him talking about Dogecoin, which a lot of retail investors have said is the big reason that they're buying, and there was a lot of hype and speculation ahead of SNL that he would talk about it. It would sort of spread the word when it came to Dogecoin, and people were buying for that particular reason.
Before we go, let's get to our numbers round. We'll start with $2 billion. The Secret Service has confiscated $2 billion in stolen COVID unemployment funds. The agency returned the money to programs in at least 30 states after it was determined that recipients had fraudulently applied for the pandemic-related relief. The Secret Service told CNBC that the criminals typically stole the identities of people who were properly qualified for unemployment benefits. The agency also said the $2 billion figure was a conservative estimate and that the investigations are ongoing. Next, 75,000. Amazon will hire 75,000 new employees across its fulfillment and logistics network in the U.S. and Canada. The e-commerce giant says the average starting pay for these new roles will be higher than $17 an hour and include signing bonuses of up to $1,000 in certain locations. The announcement comes the same day that McDonald's committed to hiking hourly wages for its workers by an average of 10%. But the raise is only effective at its U.S. company-owned stores, not the franchise locations. And the company franchises 95% of its restaurants in the country. And finally, $5 million. The Colonial Pipeline has resumed operations after paying a $5 million ransom to the hackers who deployed a ransomware attack against the pipeline, which caused it to shut down for nearly a week. A source familiar with the situation confirmed the ransom payment to CNBC. Colonial is the largest pipeline in the United States, and the company said that as of today, each of the markets it serves will begin to once again receive product. The news is especially welcome in parts of the Southeast, where some gas stations have already run out of fuel. Get the latest on all the updates in this still evolving story by going to CNBC.com and downloading the CNBC app. That's it for After Hours. We'll be back here in our home office every Tuesday and Thursday, so be sure to catch us then.